Market gives up morning gains as key indices trade near day's low, but mid-caps take a further beating as valuation fears rise. Industrials, utilities and realty are the big losers, even as FMCG and IT, the defensives, eke out some gains.
Asian Paints posts weaker than expected earnings on weak demand, which was impacted by elections and the heat wave. An inferior product mix and price cut also weighed.
LTIMindtree posts growth ahead of estimates with a recovery in the BFSI segment and sees the momentum continuing, while L&T Finance is at a near year's high after the ROA increased following retained loan push.
Significant equity dilution via an FCCB issue weighs on Zee Entertainment, and a dip in revenues and margins tells on Elecon Engineering, but Just Dial leaps on sharply higher margins and a promising outlook.
Chris Wood, head of global equity strategy at Jefferies, at the CNBC-TV18 town hall, called India as the best equity market in the world, but he cautioned that any tinkering with capital gains taxes could hurt, while a Trump win could spell risk on for equities. You're watching us here on Halftime Report. Today we're seeing some bit of a sell-off in the markets from the highs. The mid-cap index is faring much worse, down about 800 points. So we'll keep an eye out on that. But right now, as we speak, we have earnings flowing in thick and fast. Let's talk about Asian Paints. The company reported a weak set of the first quarter earnings. We spoke with the management. Let's hear out what Amit Singhal, the MD and CEO, had to say.
So actually, if you look at from the point of view of overall growth, even in quarter one, we've kind of got about a 7% volume growth, which has kind of come in. We have seen that despite a very tough quarter where the retail was affected in April and May, we have kind of seen good demand coming back in June in terms of giving us a double-digit volume growth, which has happened in the month of June overall to that extent. We have seen the rural demand uptick, which is happening, which is also another phenomena in terms of what we see would kind of get strengthened in the future as we kind of go ahead with better monsoons in terms of how we have seen the progression. The other area is the B2B segment, which was affected very strongly in the month of April, May, largely because of a government freeze with respect to their infrastructure spends in other areas to that extent, has really given us a good kind of impact, which has come in the month of June. And we feel that going forward, that would be one big area which would kind of really keep on stimulating the demand, both from the point of view of government spending, infrastructure going up, factories which are coming up, and the other area is the whole area of industrial. I think these are some areas which we are seeing definitely coming back strongly to that extent, which gives us an idea that possibly going forward, I think the double-digit volume is something which we would like to kind of maintain.
You know, for the last couple of quarters, the reported growth for Asian Paints, if you size up all the other players in the industry as well, has been among the slowest, and that's very unusual. What we're trying to get at is that, is something structurally changing? What exactly has happened during the quarter? And over the last few quarters where your reported growth has been lower than the peers?
So overall, if we see, the general band in terms of what is coming is in the range of still about a 1 to 2% kind of a band. It's not that the band is kind of really vitiated from any other players to that extent. And it's a mix of the performance in terms of what we are seeing from the general industry. But by and large, that band is something which is consistent in terms of what we are seeing. Overall, what we are definitely seeing is that given the largest player in the industry overall, to that extent, I think if there is a slowdown, it affects the leader the most in terms of what we see from a demand point of view to that extent. And that is something which we are feeling that in some of the belts, especially when we see some regions across the country where the shares are higher and so on and so forth, any demand effect which happens is something which will affect the larger player a little bit on a higher side to that extent. The second area which we see is that our industrial sales contribution is smaller than some of the other existing competition players to that extent. And the industrial growth has been on a higher uptick given the fact that whether it is auto, whether it is the general industrial protective coatings, or in terms of the industrial B2B business, I think that has been a shade better overall in the last about 6 months or so, which has kind of contributed to the additional 0.5 to 1% kind of increment in terms of some what the existing players are showing.
So would you say in the first quarter, we don't have numbers from the others yet, you would have done better than the others in the decorative side of things, or at least at par?
I would say that in general, the industry would be overall down in terms of thing. As far as the decorative sector is concerned, we would be almost at par or slightly better than the other players to that extent. In industrial, possibly some of the other players might be a notch higher.
So two-part question then. One, you said you are gunning for double-digit volume growth this year. If you could give us a range, is it going to be 10 to 15%, 15 to 16%, 10 to 12%? If you could give us that range, that's point number one. And secondly, 1% price hike has been already taken. In the next couple of months, what is the extent of price hikes that you can take?
So first of all, when we look at the overall inflation in the current quarter, it has been a little bit unprecedented. We never expected it was about 1.8%. Going forward, the prediction is that it could kind of go anywhere between 1.5% to about 2% to that extent in terms of what we are seeing. Overall, obviously, as we look at it, we don't want to pass the entire burden onto the consumer and want to do some balancing in terms of our internal initiatives as well. But definitely, as we look forward, anywhere between 0.5 to another 1% is something which is in the offing if this kind of inflation continues.
And on the volume front, what is the target?
Volume, quarter two, definitely, I think when, as I said, we are looking at closer to about 10% in terms of the overall numbers, in terms of what we are seeing. 10 to 11 is something which we would kind of really right now peg the number at.
And for the entire year?
I think it is at this stage a little bit early to say about the entire year to that extent, but I think first come first, I think we talk of quarter two, and let's see in terms of how the festive demand really augurs as we look at the year.
You know, you have been speaking about poor consumer sentiment, unprecedented inflation right now, and then the street has this fear of competition as well. So it's a trifecta of problems, so to say. Which of these issues worries you the most? Which of these are you least worried about?
So overall, I think given our distribution, our reach, our spread across the T3, T4 is also very, very strong. I think the uptick coming from the rural and the smaller towns is something which worries us the most in terms of what comes in, because that is a demand uptick which has to happen, which will be a little bit of a propellant in terms of giving us the entire sales. The second area which is very, very important is the uptick with respect to the premium and the luxury segment in terms of what we see. We have seen a little bit of downgrading as well, which has been happening in the T1, T2 cities overall to that extent. That is one area which is a concern to us, because if that area doesn't improve, it kind of affects our value mix in a very strong manner in terms of what we see going forward, and that has a larger impact in terms of the overall performance. And the third area which we see is the institutional builder segment specifically, where it is a large segment, and if the construction activity, which is good as of now in terms of what we expect, but that is a big propellant in terms of the overall B2B sale, which kind of happens in terms of going forward. So I think I would kind of really peg myself on these three areas if you look at in terms of as being a clear source of growth as we go ahead.
18 to 20% margin guidance band, you would look at it at a higher end of the band or lower end of the band? Because right now you're absolutely in the middle, closer to 19%.
So I think we would like to be definitely around the 20% kind of range in terms of going ahead. But definitely, I think something around 19 to 20 is we would like to kind of maintain.
We've seen an increase, a marked increase in your employee expenses, other expenses. You are improving your distribution and all of that and stuff. Any senior structural management leadership changes in the offing?
No, not anything at the overall top level management in terms of what we are kind of looking, but largely we are looking at giving ourselves a far more stronger focus imperative as far as our overall distribution structure is concerned. Given the fact that we keep on adding many distribution points, and over the past about 3-4 years, we have really exponentially added the number of distribution points, and we are closer to about 1.65 lakh retail points. I think we are adding a lot of manning in terms of from the point of view of the front line and the level next to it, which is a supervisory level to that extent, so that we are able to kind of reduce the span of control, have a better focus, and able to really augment various initiatives in terms of what we are taking in terms of reaching out to the consumer.
You know, when we speak to you, we also speak through you about all things in the industry. Being the industry leader, you've been able to take price hikes in an unprecedented inflation time, at a time when, you know, there is competition as well. How should we look at that? Have you been able to size the competition up yet? They've been in operation for more than 100 days. Do you think the intensity is stronger than you anticipated, or is it weaker than you anticipated? How are you managing that?
So I think overall, like what we have been maintaining, I would like to maintain that it is as per our expectations. We didn't see any big kind of disruption happening in the market overall to that extent. I think overall the newer competition is also struggling in terms of finding their own ways in terms of going ahead. But I think it is still early days to see in terms of what they're doing and how they are kind of progressing forward. As I've always maintained, on an 80,000 crore industry, I think the cumulative new competition in terms of the 3-4 players who have kind of come in, even if they log in even a 2% or 3% of the total number, I think it doesn't really impact the overall industry dynamics in terms of going forward to that extent. So as I have maintained, I don't think so that it is something which is from the point of view of numbers going to make too much of the difference. Yes, the market sees a lot of areas in terms of what is happening, a lot of distribution points get affected. Sometimes the dealer sentiments get affected overall to that extent. But largely from a point of view of numbers, we are still maintaining. I don't think so that this year is something which we will see any movement in terms of largely the market configuring very differently.
All right, not this year. So let's wrap it up with your this year's numbers. You said that the gap between volume and value would be around 5 to 6%. So to that extent, can we expect you to do margins upwards of 19%, mid-single digit sort of revenue growth for the full year? If not for the full year, at least the next quarter where you have more visibility?
Definitely. I think the Q2 is something where we are aiming in terms of looking at that kind of objective, in terms of looking and definitely improving our margins as we go ahead. And that is something which we are putting our full force in terms of the imperative, in terms of bringing it back. And I'm confident that we should be able to get that going.
All right, that was the management of Asian Paints speaking about double-digit volume growth for this year. In this particular quarter, the second quarter, 10 to 11% volume growth with margins close to around 19 to 20%. More importantly, they've already taken a price hike of about 1%, but in the very near future, they anticipate another 0.5 to 1% price hike as well. We take a short break on that note, come back on the other side, we'll get you key excerpts from our exclusive conversation with Chris Wood.
Welcome back. Well, just a little bit of a recovery which has taken place for the Bank Nifty, so higher by around 27 odd points. We have the mid-cap index which has recovered a little bit from the day's low as well. So the mid-cap index should come up for you. Largely, it is a day where we are seeing pressure on the broader markets, and that's indicative in the advanced decline ratio, which is favoring the declines at this point in time. So it's around 1:2 in terms of a ratio for the Bombay Stock Exchange. But let's get in some opinion then. India is the best long-term equity market in the world. That's the word coming in from Jefferies' Chris Wood as he visits the CNBC TV18 studios for a town hall on the markets. In an hour-long session, Chris Wood gave his take on the performance, valuations and the outlook for the Indian market. Listen in.
India is the only stock market I'm aware of right now where the small mid-cap sector is doing way better than big caps. Absolutely unique. And it's driven by this domestic phenomenon. This is not replicated in any other market right now. India is the best long-term equity market in the world. Clearly, the US has done fantastically well. But in the emerging market Asian context, yeah, India to me remains the great domestic demand story. You have this very emerging equity culture. But what, as you rightly have just highlighted, is amazing is the dynamism of the local asset management industry and the growing retail participation. And actually everybody, I've been in Mumbai 2 days, everybody in the from the financial industry, I think, is staggered by the resilience of the market following the surprise election result. My understanding, obviously, the excess valuations in India, or the perceived excess valuations of the small mid-cap area, but my understanding in recent quarters, they've had the best earnings growth too. So it's not completely divorced from underlying fundamentals. No, the only issue, the risk in India is simply that some of these stocks are very high valuations, so there's a risk of earnings growth disappointments. The big point for your viewers to understand is the foreigners are remarkably underinvested in India. So we believe that the global emerging market funds, who are the prime investors in Indian equities, are barely neutral in India, partly because the neutral weighting of India has gone up because it's outperformed, and partly because they haven't really been able to get into the market because the local money has kept it at valuations where they're not comfortable with.
Right, that's not all. In fact, we also spoke with Nilesh Shah, who's the MD and CEO of Envision, and this is what he had to say on a whole host of things, including market and the IT sector in particular.
I think the most insightful takeaway was essentially that it's yet the start of the bull market in India. And the potential of NPS, the potential of pension money coming in, it just shows how long the runway of liquidity is for. We're all aware about the kind of runway that growth has in India. But I think that was a very, very interesting kind of an insight that he shared, that what happened in the United States between 1980 to 2000 for 20 long years, there's a very strong possibility that we could see a repeat of that in India.
So the power of liquidity could keep the markets higher. So while it's great, you can keep your SIPs going, but to put fresh money to work at these levels is concerning for a lot of people. How would you respond to that?
No, I think the best way to really do that is to juxtapose in terms of what's the long-term potential. I think in the short term, we could probably look at how the markets have moved up, how they have been resilient, how valuations are not as reasonable or low as they were maybe a year or 2 years ago. But I think when you kind of fast forward to 3 years, 5 years kind of perspective, if you have that kind of a perspective, I still believe that there are pockets of opportunities, there are pockets of undervaluation or pockets of reasonable valuation, and that essentially should be the big focus area.
So what's the emerging opportunity for you?
I clearly believe that the big opportunity is still going to be around tech-oriented businesses, not the conventional IT services, but businesses which can use technology to reach out to millions of consumers, billions of investors.
Give us an example.
Savers. I can't mention specific name,
but
I think
new age e-commerce companies.
Absolutely, e-commerce companies, fintech companies, companies which are providing technology in creation of the digital public infrastructure. I think that's a reasonably big universe. I mean, if you really look at it, every 5 or 10 years, we've had essentially a rotational change in leadership. Right? We had earlier the private banks or some of the leading NBFCs. Then it came over to PSU banks. I clearly believe the next 5-10 years belong to fintechs. Similarly, on the consumption side, there was a time when staples were really the preferred bets. I think going forward, it's going to be some of these online consumer internet plays.
And here, you're not concerned about the valuations or the run-up we've seen?
I think the way growth, I think these are businesses which essentially are going to witness hyper growth. I clearly believe these are going to be the hyperscalers of India. And I think when you have businesses which are going to compound and grow at maybe 25-30% year on year for say 10 long years, I think the power of that can be very magical.
What about the budget? What's your expectation?
Well, huge expectations. This is essentially going to be the first budget of the government in its third term. It's going to be important to see whether there's going to be continuity or there's going to be continuity plus a lot of new changes. I just hope that the focus on infrastructure even amplifies further. Clearly, I think social spending is going to take center stage, which will essentially prop up the rural economy and ensure that we have more strong all-round growth in the Indian economy. So I think infrastructure, social spending, I think these are the two big areas that the budget is going to focus on.
Have you booked profits in any themes? And if yes, which?
Not really, but yes, surely kind of cutting down exposure on the capital goods side.
Why? Is it just the valuations or growth is slowing down?
No, I think the valuations now, versus like, I think we bought many of them 2 years ago, 3 years ago. when valuations were a lot lower. In the meantime, these businesses have grown at 20-30%, but the market caps have grown by whatever, 200, 300, 400, 500%. I think now no longer are these businesses at 20-25p, they're at 70-80p multiples.
Going up to 100
and going up to 100 in some cases. So I think we're not exiting, but yes, we are surely pruning down exposure.
So which would be the big overweights for you now?
I clearly think we are going towards fintechs being a very, very big overweight right now. I think in addition to that, some of the peripheral financials, not just fintech, but outside of the banks, so some of the insurance companies, some of the AMCs, I think distributors of financial products, I think that space is really becoming now a significant overweight for us.
And IT, what have you made of what we've seen from TCS, HCL Tech? The tide is turned?
I don't think so. I clearly believe that the best is behind them. If you just really look at it, I think the market is cheering that instead of 2% growth, they've ended up with 2.5% growth. That's about it. Yes, surely the results have been a bit above expectations, but I don't think it's good enough. These are probably just going to be tactical bets. I don't think you want to make long-term strategic bets here.
Okay, we spoke about IT. That was the last question. But just look at the way TCS, LTIMindtree are moving in today's trading session. TCS is your top gain on the Nifty, up 2.5% gained around 9% this month. LTIMindtree up around 1.7%, reacting to numbers. That stock has gained around 5% this month. We'll take a short break. On the other side, we'll get you F&O updates. Stay tuned.
Welcome back. You're watching us here on Halftime Report. It's a Thursday. It is Nifty weekly options expiry. Perfect time to actually get you what the F&O setup at midday looks like. It's been fairly volatile for the markets. The indices are off highs, but they're also off lows. In fact, the high on and the low on the Nifty, are pretty much telling you of the range that the street is anticipating. 24,500 was the low in today's trading session. And at the higher level, we went all the way up to 24,678 thereabouts as well. And this, even as the Nifty bank has been slightly under pressure, the mid-cap index more so with a cut of almost a percent point to itself. What's keeping the Nifty afloat is the outperformance that is coming from the IT space. So we have, all the IT stocks coming up for you. Infosys ahead of numbers. TCS doing extremely well. LTIMindtree too, post a mild beat coming in, has supported the frontline index. And ahead of, all the key events like results, we have Reliance reporting tomorrow. We have HDFC Bank over the weekend and the budget. Then next Tuesday, we have India VIX, which has spiked to around 14.5 as well. Ahead of options expiry today on the Nifty, what are the levels that we're looking at? 24,600 call has been pretty active for a premium of close to around 23 rupees odd. And now we're seeing some short covering out there as the Nifty is moved higher. At the lower level though, 24,550 put is equally active, telling you that 24,500, which is closer to today's low, will see some sort of support coming by. On the way up though, the 24,650 call is equally active. 24,700 is an important zone to watch out for. So short point, 24,500 to 24,700 is the range that the street is working with. But very stock specific in terms of today's market. And I'm looking at 4 stocks which may actually enter F&O ban. India Cements, a lot of open interest beyond the 95% mark in terms of market-wide position limits. Hindustan Aeronautics itself could get into F&O ban. And then we have another couple of stocks as well, the likes of L&T Finance and SAIL. Both of them could enter F&O ban.
Okay, all right, Manglam, thanks very much for that. So that's on the F&O space. Nugent Software reacting to what has been a 55% fall in terms of the profitability this time. That's the reason that you're seeing the stock down around 6% at this point. The profit has come in just about 47 odd crores and the revenue has dipped around 16% year on year as well. As you can see, there's a sharp dip in the stock reacting to what has been a poor performance this quarter on a sequential basis. So 47.6 crores compares to over 100 crores just done in Q4 of FY24. The EBIT has fallen massively as well. We'll have to wait by for more details and what really went wrong this quarter, but it looks like a very disappointing set of numbers. We'll take a short break. Up next, we'll be talking to a management. Anand Goenka, Vice Chairman, Zensar Technologies, will join in to discuss their recent acquisition in the US and the company's business outlook. Stay tuned. Welcome back. Well, let's talk stocks now. Zee Entertainment is in focus after the board approved the issuance of a 10-year foreign currency convertible bond worth $239 million. Mangalam, you're tracking this story. The stock is under steep pressure today on account of this. Tell us more.
Well, it is under steep pressure, not just today. Over the last 6 months or so, it's down almost 41, 42 odd percent. Ever since, the deal with Sony was called off, we've seen a big cash in Zee. So until then, the street was hoping for some sort of fundraise come by for the company, some sort of corporate announcement, a strategic investor perhaps as well. In light of that, there was a lot of hope that, this fundraise announcement that the company would make would entail some strategic investor. That wasn't the case to be. Instead, the company has gone ahead and chosen the route of foreign currency convertible bonds worth nearly $240 million, which eventually would be converted into equity at around 160.2 rupees per share. In case of full conversion, the post-money dilution would be close to around 11.7%. And that leaves you with the question of what happens to the promoter stake, which is already at around 3.99%. A 10% dilution in that would take it further lower to around 3.6, 3.7% itself. So in the very near term, if there is no conversion, then it pressurizes their balance sheet with the presence of that debt of almost 2,000 crores on their books. And if there is conversion, then there is the risk of that dilution. Amidst all of this, no sign of any strategic investor or big corporate announcement that the street was anticipating coming by. So only making problems a little more for Zee, and that explains the kind of cut that we've seen on the stock price.
Okay, as you can see, the stock is down around 8%. That's on the FCCB issuance. But I just want to point out one particular stock which you should keep your eye out on, RPG Life. That stock is up around 5.5% today. It comes out with its earnings tomorrow, but it's been on a tear. In fact, the stock has gained around 23% this week itself ahead of its numbers, which come out tomorrow. And it's gained around 43% this year. So it's been a big mover. RPG Life is the one I'm talking about, 1,922 odd rupees. So let's see what it delivers in terms of numbers tomorrow. In fact, a lot of these RPG group companies are doing well. Even CEAT is up around 3 odd percent. But nonetheless, RPG Life is one stock that you should probably keep on your radar ahead of those numbers tomorrow. But let's look at some other big earning reactions. LTIMindtree surged post reporting its Q1 numbers. It's one of the top gainers on the Nifty today. Rima's here to tell us more.
Thanks so much for that. So for LTIMindtree, the beat has come in on the top line. The company has had multiple sluggish quarters. Q4, the revenues declined, but this quarter, growth has bounced back very smartly, 2.6% on a quarter-on-quarter basis, higher than estimate. And the key positive is that BFSI has returned to growth after 4 quarters of a contraction. Margins, profits in line with street expectation. But the management commentary was also fairly upbeat. They talked about momentum sustaining or continuing into Q2. They also spoke about while the broader environment remained unchanged, they are seeing some recovery in high priority transformation project, particularly in BFS, and BFS itself will sustain growth through the whole of FY25. Motilal Oswal has upgraded the stock to a buy, target price 7,000. They expect LTIMindtree to outperform its peers, and they're expecting the company to report low double-digit growth in FY26. That said, margin is a bit of a concern. Back to you.
All right, Rima, thanks a lot for that. In fact, you're also tracking Just Dial, a big mover in today's trading session.
It's a big mover on the back of a big expansion in their margins. Look at the margin trajectory of Just Dial. In the last 1 year, the margins have doubled. So from 14%, it now stands at over 28%. And every single quarter, the company has been improving their margins. They now stand at a 2016 high, aided by cost reduction. The paid campaigns has slowed down, but you would say it's kind of steady at about 8% for the last 2 or 3 quarters. The company is targeting mid-teens revenue growth, EBITDA margins of 25%. The board is also working on a dividend policy, and their endeavor is to return 100% of the profits to the shareholders as dividend. That said, Ambit says this margin obsession is costing the company growth because collections for the company have slowed down to 5% on a year-on-year basis. So that's something you need to watch, the margin versus growth trade-off at Just Dial.
Okay, all right, Rima, thanks very much for that. Well, very busy week for you. Infosys will also be reporting its first quarter numbers today itself. What can we expect from the IT major?
the key from Infosys is going to be the commentary, whether you are seeing some green shoots, because all the peers have reported slightly better than expected numbers. So whether Infosys commentary also echoes the same sentiment. In terms of numbers, expect a pickup in growth. So about a constant currency revenue growth of 2.4%, 2.5%. This will be aided by ramp up of deals which they won last year, and to a reversal of 100 basis points charge that they had on their top line. So the base had gotten impacted. Margins seen up 60 basis points to 20.7%, driven by the revenue growth in the absence of wage hike, and profits seen up 3.5%. Expect the company to hold on to its guidance of 1 to 3% and margin guidance of 20 to 22%. The stock is done pretty well, up more than 10% so far this year, but the key is going to be commentary and whether we are seeing some green shoot, early signs of a recovery. Back to you.
All right, Rima, thanks a lot for that. The stock up 10% in July, so far ahead of numbers. Let's slip into a short break. On the other side, as promised, we'll get chatting with the management of Zensar Technologies to discuss their recent acquisition in the US and the company's business outlook. Stay tuned.
Welcome back. Well, let's talk about a couple of companies now. Zensar Technologies is on our radar. The company has acquired 100% stake in US Bridgeview Life Sciences to boost their healthcare and life sciences focus. To discuss all this about the new acquisition and the business in general, we have with us Prateek Maru, who's the head of the healthcare and life sciences vertical at Zensar Technologies. Prateek, hi, welcome to the show. Well, if you could just start by giving us a sense in terms of what is the rationale behind this particular acquisition, how much does it boost your capability in healthcare, and how much is healthcare probably going to contribute going forward? It's currently around 9.5% of sales.
Hey, thank you, and it's a pleasure to be here. The primary reason for the acquisition is our intent to boost our capability into the healthcare sector, particularly in the pharma, commercial, and product launch space. We expect this is a growth play for us, so it's not about adding the revenue for this quarter or next quarter. It's about building the capability that helps us drive future growth. We expect to get to close to the 10% revenue in a quarter post-acquisition. But we expect stronger growth as we continue based on this acquisition.
What is this growth? Because, I mean, you also have, to make a payment of around $11 million by December 2027 contingent on some performance. So what we're trying to understand is, what is this performance? What is the milestone that you have here? If you could quantify that for us. And with this money that you're paying, how much is the kind of return that you expect?
Yeah. So we have typical to acquisitions like this, we've set up internal thresholds of the performance, and we would measure the progress very closely on how well the acquisition is doing. We've not disclosed the specific terms and milestones, but this is something that we are setting internal governance at our end to ensure that we meet the performance benchmark. We also would continue to look for other acquisitions. So this is a template that we're following. This has been successful for us in past when we've done the acquisition has yielded the result.
We're not asking you to, divulge internal information or confidential information here, but you are paying upfront $14 million. A couple of years from now, you would be paying another $11 million. So net, $25 million would be the total cost of acquisition. As a result of which, what is the kind of IRR that you're looking at? That's what investors would like to know.
Yeah. So this is certainly the business case is built on ensuring that the IRR from the acquisition is higher than the cost of capital that we're deploying. We don't disclose the specific growth number associated with any acquisition, but it's certainly positive for the margin, certainly positive for the revenue growth. And we expect to deliver within the HLS space, we expect to deliver higher than the company average growth.
So when is the integration expected, and it will be margin and EPS accretive from day one?
Yes, that is correct.
When will the integration be effective?
So we have laid out a 3-year plan, as it was mentioned as well, right? That there's 11 billion of payout happening in 3-year terms. So the integration is going to be, we are going to be doing certain part of integration at an accelerated mode, primarily around the account and customer relationship. So those takes priority. So the internal operations activities, the financial integration, the back office integration, that will happen slowly over the period, culminating in 3 years.
Okay, and you said it's margin accretive. Could you give us a sense of how much, what are the kind of margins on this near 13 million revenue that this company does?
Yeah, so again, we've not disclosed those specific terms, so I'm constrained by mentioning any numbers. But the only thing I can mention at this stage is that this is margin accretive, and this adds to the Zensar margin.
Okay, give us a sense in terms of the access that you would get with this particular acquisition. For example, what is the clientele like? Would you get access to Fortune 500 companies? Are you likely to bag larger deal sizes? What is the expectation once there is this integration which is complete, and what this particular acquisition really brings to the table for you?
Yeah, certainly, and that's the most interesting part for us. Part of the acquisition, we're obviously getting strong capability in pharma commercial domain and Viva technology, Viva cloud, but also a good access to the clientele. And these are the clients where Bridgeview has done meaningful work in helping those clients in the journey of the product commercialization, doing the launches, and so on. For their size, they've been extremely effective in building the portfolio of the small and medium-sized companies, which is one product, pharma and biotech. But they also have companies which are in the top 15 pharma. So part of the transaction, we are inheriting those relationships, and obvious intent is to grow. The future segment that we would be focused more on is continuing going to be on the small and medium sector in the pharma and biotech. So the ideal candidate for us would be small companies which have some innovative drugs, therapy in the market, and they're looking for help on the commercialization of those products. So we become the preferred partner, the partner of choice for them to help them on the product launch.
Right. You said that this is margin accretive. Last time you did margins of closer to 15%, so one assumes that it will be more than that. But, at around $13 million, this is about 2% of your current revenue. So what we're trying to also understand is that, what are the kind of cross-selling opportunities that you have here, upselling opportunities, and what is the scale that you can bring to this business, and how much bigger can you make it, say, over the next 4 or 5 years?
Yeah. So again, we don't give the forward-looking guidance on the revenue, so I'm constrained of what I can share. But when you look at the client portfolio, and we've done the analysis at client by client level, there's a good amount of synergy there. We don't have an overlap of existing clients, so we're not in a situation where we have to cannibalize revenue in any sense. This is all driven toward the growth. As you may also have noticed, Bridgeview Life Sciences, the current portfolio that they have is primarily focused with the on-site resources that they have. Augmenting them with the global scale and the offshore capability that Zensar brings to the table, this becomes a highly synergistic for Bridgeview business as well. So we expect to grow both sides of the revenue profile, the standalone revenue for Bridgeview, but also the revenue at the Zensar, our legacy portfolio.
Okay. All right, Prateek, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's Zensar Technologies talking about their latest acquisition. Need to take a short break. On the other side, a commodity segment. Manisha Gupta will be connecting with Nirav Desai, partner at GGN Research, to discuss the edible oil industry wish list from the budget. Welcome back. Manisha Gupta caught up with Nirav Desai, partner GGN Research, to discuss the edible oil industry wish list from the budget. Listen in.
I feel the most important thing is this government is very unpredictable. We never know what they come out with. But yeah, we are expecting that there should be a duty differential between the crude oil and the refined oil. Also on the crude oil, what they can do is a dynamic duty structure. So I think it is a good balance between the consumer and the farmer. So if the prices are low, the duties can be high. And if the prices rally and go high, then the duty structure can come lower. So I think that could save both the sides. On the edible oil mission, yes, I do feel the government had started a very good thing known as AIDC in the import duty structure. So AIDC was Agriculture Infrastructure Development. So I think that is the key. That's the most important thing that the government has to focus on, because we can't get every time new area. India has, especially in the Kharif crops, very less area that can be taken into new crops. I think the only solution is the higher yields. So higher yields have to come with better infrastructure with the farmer, maybe better canals, better equipment and other things.
So when it comes about the national mission, and since the government has been talking about self-sufficiency in pulses and edible oils, do you think edible oils is something that is faster to do? Because we've seen a big crop of mustard, we've seen huge imports, of course, of palm oil coming in, soybean is into sowing right now. How do you see government really maneuvering that?
So I think there is no comparison between pulses and oilseeds, because if you go by the area, the pulses area is very small in front of the oilseed. But even with that larger area, we are producing less oil, as in our import dependence, as you said, was 60-65%. Some years it even goes up to 70%, 68%. So even with that high acreage, we are not able to get lesser import dependence. So I think pulses is a swing with a smaller area going from oilseed to pulses also. They kind of cover up with the shortfall that they have. So I think there has to be a different solution. And that's what we discussed earlier, that it has to be some yield improvement, and drastic yield improvement has to come.
Okay. Another thing is that edible oil prices have been very, very volatile. I mean, of course, every Indian kitchen has edible oil. We've seen it taking very strong precedence in food processing, the snacking that we do, and palm, of course, is used in various industries from pharma to cosmetics, etc. The kind of price volatility that we're looking at, and the point that there is no hedge mechanism, how is that bothering you guys?
No, it's completely bothering us, because I'll be frank that not everybody can go and hedge into the BMD. And when you go into hedge into the BMD, there are so many regulations, there are so many currency exposures that come in. So a very simple task of going and hedging on an NCDX or an MCX future is now become very complicated, very tedious. So we are definitely missing that. On the other hand, there was a market that was developing. There was a complete warehouse receipt market that was developing. There was a kind of an electronic market for the physical that was developing. So I think that was a complete ecosystem that we disturbed, and we should immediately start the futures in India back. And we are seeing in China, we are seeing in US, we are seeing in other countries that the commodity exchanges are living in countries where they are consumers themselves, and still it's helping the industry, it's helping the government, it's helping the farmers.
One final thing, and almost everybody seems to believe that this budget could see a big push coming for the agri as a sector. So while you've spoken to us about edible oil, where do you see within agri? Is it going to be about infrastructure, manufacturing, technology, seeds that the government will put a push on?
So listening to our favorite Mamaji from Shivraji, because he comes from my state, I think he is focusing on the seeds, higher yielding variety seeds. Yes, I feel other infrastructure development would also be on the cards, but we'll have to come to know on the budget where they exactly hit it. But yes, whatever he has been coming up with, and he has been an agrarian, he has, or whenever he was handling MP also, he was very, very farmer focused. So I think he should come out with some good steps for the farmers.